Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. On this episode, we've got David Szybunka of Canoe Financial. They're one of the last men standing when it comes to an exclusive fund dedicated to energy. And guess what? They are outperforming the index. They're definitely outperforming crude oil. So we're going to find out why they're doing that. And David says this is just the beginning. He says we're in year 5 of a 15-year bull market for energy, and he lays it all out for us. Let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. When you choose a Raymond James advisor, you're getting more than independent financial management. You're getting access to complete financial guidance under one roof, from tax and estate planning to trust services for generational wealth and strategies for life's key milestones. Whether that's buying a home, funding your children's education, or preparing for retirement, they bring it together in one financial plan. What also makes Raymond James Advisors unique is their complete independence. With no proprietary product to promote, you'll benefit from personalized services, all backed by the strength and resources of Raymond James, a powerhouse with $88 billion in assets and over 520 advisors nationwide. Discover how Raymond James can help you live a life well planned. Visit raymondjames.ca. David, thank you so much for joining me on the podcast.
Hey, thanks a lot for having me.
I wanted to jump right into the energy cycle, but I think in the spirit of Bill Ackman's tweet over the weekend, his dating advice, may I meet you? Let's meet you first. Let's find out who is David Szybunka at Canoe. You're one of the biggest energy investors in this country, and you've stayed an energy investor despite the cycles that we're in. You never kind of skewed into being a generalist when oil was out of favor. So let's talk about Canoe and your history as an energy investor.
Yeah, that's a great tee up there. There's only one or two of us left in Canada, right? And so, look, I started my career in 2007. And so that was kind of midway through the last energy cycle. And I started at Peters & Company. Peters & Company is an energy boutique here in Calgary. And talk about a rock star way to kind of start your career. Like, I got to go to work every day with what I would define as like an all-star team. You had Mike Timms, who started Peters & Co. You had Ron Wiggum, Mitch Malloy, Chris Potter, Jeff Martin, Steve Lark. Like, these are rock stars within the industry. And I got to be the young 20-some-year-old, just essentially watching these guys do their day-to-day, right? And I got to see capitalism at its finest with that. And so you shift this over to 2011, I move over to Canoe Financial. Again, Bruce Chernoff was the founder of Canoe Financial. He's an energy guy by background, rock star. You don't bet against this guy. He's a winner. And Canoe's winning today. And so I've just been very lucky throughout my whole career to be around what I would define as the best energy groups within Calgary and industry. And so that's been really good for me.
And I'm going to let you do a bit of a victory lap on performance because this is a tough environment, a tough market to outperform, which you guys are doing. You're outperforming the index, you're outperforming crude oil, and that's like in the near term and over the long term. Tell me how you achieve that. Are you required to be kind of a perennial bull in the market, or are you able to kind of bob and weave depending on where you see the opportunities?
Yeah. So, I mean, tying it back to kind of how I was talking there, like I got unbelievable training from just some really smart people within industry. I owe the world to those guys. But when I started managing capital, 2012 to 2014, that was the later stages of the bull market, right? And so you just kind of had to have an energy fund and you did pretty good, right? And I was like, man, I'm so smart. I look at all these subsectors. We're buying natural gas and then global LNG and then refining. And so we don't just own oil. We own various things within energy, right? And shifting around there, I was really good at. I'll tell you, I did not understand cycles, right? When you go through a downturn from 2014 all the way through to 2020, it makes you better as an energy investor when you go, I didn't think this could get this bad. And when you go through that and actually go back to the history books and understand cycles, it makes you a lot better. So you kind of got to know where to be as you play out these cycles. And I would just say, as you talked about our performance, it's been rockstar for the last 1, 3, 5 years, to your point. I got the best energy team across Canada with Nick Sokol and Courtney McKean helping me out. But we do a really good job on, okay, at the start of cycles, let's respect the flows and understand that people aren't going to be rushing to all these mid caps. They just got scorned from a massive downturn. So you kind of want to have a little bit more of a large cap bias. But then as you play out the last 2, 3 years, the sector's been going sideways. To your point, your subsector selection gets a little more important. Picking natural gas equities as an overweight last year, as natural gas prices were the lowest level in 20 years and everyone was bullish oil, we were up 25+% last year because of that distinct call. And then now just understanding as you mature through this, should we have a few more mid caps in the portfolio? And so it's all these things that I'm describing together, but understanding where you are in these cycles that have caused the outperformance.
So that sets us up perfectly for my next question, which is, where are we in the cycle?
Yeah. And so we think we're year 5 of a 15-year cycle. Okay. So we bottomed at the COVID lows in 2020. In 2021, 2022, our funds were up 100% and 50%. So you had these massive moves off the bottom. Everyone's kind of starting to get excited about energy. And I would just say you were due for this digestive phase or period that we've been going for 3 years. But in 2022, that was a good example. Like our funds were up 50%, but the broader market was down 22%. And you could feel pain in these other areas of the market. And I've referred to it as a gorilla in a bathroom, and shampoo bottles are getting knocked over all over the place because you could just feel the capital coming into the energy space, and there's so much money in these other places. I haven't felt that for 3 years. Okay. The last 3 years, to lay it all out, like that 2012 to 2014 period, what were we seeing? Well, we watched our Canoe energy funds go from $20 million to $800 million in 2 years with 5 sales guys, and no one knew what a Canoe was. Again, a function of the cycle, not a function of me, performance, whatever, but a function of the cycle. There was no discipline by the companies. Grow, spend. I always say what ends a capital or a commodity cycle is a capital spending cycle where investors embrace the spending. That was very prevalent in that period. No focus on profits, no focus on shareholder returns, energy sector outperforming other sectors, valuations high as you look back, capital just roaring in. Today, that is not where we are. We are reluctancy, hesitancy, companies focused on profits, shareholder returns, bit more growth today than there was, but there's no embracement for capital spending. The sector's underperformed other sectors as a whole the last 3 years. You've had to be in the right subsectors of energy to do well. But energy's underperformed other areas of the market. Valuations are low. The debt in the capital structures is much lower than it used to be. This is a good time to be buying volatility and dips because we think we're in year 5. And we think we'll eventually inflect out of this. But to kind of word it to everyone in a simple way, the stages of the cycle are disbelief, optimism, and then everyone gets bullish by the end. Your taxi driver's pitching you energy stocks by the end of it. And we think we're getting closer to moving out of this disbelief stage to optimism because of our starting points. Like 2022, after those big moves, oil was 100 and natural gas prices were 9. Inflation was 9%. Interest rates have been going up. Well, the last 3 years, the commodity prices have been retracing. Now we're at $60 oil. We're at $3 to $4 gas. Interest rates have been coming down. Inflation's been coming down. Our points of entry on these earnings about to reaccelerate. We think we're just dancing with the last leg of the bottom in the commodities before another move higher.
Okay, so let's unpack some of that. I hear you saying that we're not at anywhere near enthusiasm for the sector, but there is performance even as oil prices are down. almost 17% in the last year. The TSX energy sector is up 15%. Now that contains a bit of uranium, but even when you strip that out, those oil and gas producers are still higher. So what is that disconnect? Why are the stocks doing better than the commodity right now?
Yeah, I mean, you've identified kind of what we've been saying for a while. I think the last 1-2 years is like, we're in the digestive period. We're in the thaw, right? At the start of cycles, everyone gets much too focused on oil prices, government policy, pipelines, all this type of stuff. And by the end of it, they don't even talk about that type of stuff. And so in the digestive thaw period, which is the sideways period from the last 3 years, a lot of healthy things have been happening, right? The certain multiples 3 years ago, they're just too close to each other. The best in class assets are trading very much to the bottom quartile assets. Well, through the digestive period, you watch the better quality assets get the right valuations. You watch the stocks outperform the commodity. We've just been in this thaw period, moving through this thaw period. It hasn't been and then the commodities reaccelerate yet. But what's been happening in this sideways period is it tends to repeat itself through history. And you go, that initial move was commodities up, stocks up. But the valuations didn't really expand, right? And now the last 3 years, it's kind of like commodities down, stocks doing okay, and certain multiples or stocks within the sector are starting to outperform. This is all very, very healthy.
And so you're not concerned that multiples, like these stocks are getting too expensive considering what's going on with oil prices, that like it's still sub 60?
Yeah, I think the next move is commodities up when everyone's looking down, and then you get further multiple expansion and the higher commodity. That's the prize. Like that's the prize of the cycle where you go from 3% of the S&P as an energy weight to 9, 10, 11, 12. And so we haven't had that, right? It's been the other way. Other sectors have been outperforming. Capital has been leaving. Everyone's been underweight our sector, but it's quietly doing okay, right? It's quietly doing okay.
Let's talk about, I think people might get excited. Okay, we're in year 5 of a 15-year market. And then what stops people dead in their tracks in Canada is regulation and politics. I think it was for different reasons that 2015 was the start of an ugly point for the energy sector, but it also is emblematic of the last 10 years. The country has been in a little bit of malaise. And Mark Carney, the Prime Minister, has addressed that. I think there's a lot of questions, though, about how far he's willing to address that when it comes to the energy sector. What conversations are you having as an investor about what politics means to this 15-year bull market?
Yeah, and so the way that I think people need to think about this is the commodity trumps everything. Like when those commodities are all pushing higher and gold's breaking out and oil and copper and everything together, government policy takes a back seat, right? I'm not saying government policy doesn't matter, but I'm saying commodities trump it. And like, I'll tell you a quick story from like 2012. I'm managing these funds 2011. I remember Ned Davis from Ned Davis Research, independent research shop. They came into our office and he's just like, US dollars bottomed and it's in an uptrend. We think we're going into a multi-year uptrend. And that tends to be a headwind for commodities. And gold had rolled, and copper had rolled, and iron ore had rolled, and silver had rolled, and all these commodities are rolling. But I'm living that 2012 to 2014 period. I'm like, what is he talking about? Like, I'm in a bull market. So sorry, every commodity was going to roll, but not oil. And now you kind of flip it, and it's just like smart guys from Goldman Sachs are just like, I think we're at the start of a multi-year downtrend for the US dollar. And are they right? Are they wrong? I don't know. But we're watching gold breakout and copper breakout and all these metals are breaking out. But oil's just going to stay in the low 60s or whatever, 50s forever. Like you're just trying to respect the flows of the macro commodity over policy. Because if that's ultimately what happens, policy will take a back seat. So one thing I would just kind of walk people through is they've been too focused on policy, oil prices, all this type of stuff. But let me just walk you through a bit of a time frame here. I know one question that people always ask is how has the multiples been expanding as the oil price has been coming down? You kind of asked me about that. And look, let's start in 2023. 2023, Suncor tried to buy Total out of Canada. And all of a sudden, ConocoPhillips exercises the right of first refusal. And all of a sudden, this big super major buys oil sands assets in the middle of ESG.
Mm-hmm.
We're all talking about ESG, but quietly, there's a new player buying $4 billion plus of Canadian oil sands. 2024 comes in, energy demand tied to AI. Everyone's focused on the power. And like I said, the natural gas equities were the best performing areas last year as natural gas prices are the lowest level in 20 years, right? Lots of mergers and acquisitions have been going on. Your Meg Energy gets bought out and everyone reacts and goes, who's next? Athabasca could be next. All of a sudden, Athabasca is hitting 52-week highs because there's not another 5 megs behind.
Mm.
All of a sudden, you're not looking at the oil price, you're looking at the assets again, right? To stick to that Athabasca example, you watch their Q3 reporting that came out here a few weeks ago. You know what? We're going to develop this new corner asset and develop this corner asset in 15,000 barrel day tranches in the coming years. We're going to grow this asset out. Sorry, you're going to grow this oil sands asset out. Like if this press release came out 3 years ago, the stock would have been destroyed. Quietly, it's hitting 52-week highs as everyone's like, I like these assets, right? You think about Total Energy. Earlier this summer, the federal election's happening, and Total Energy, they quietly take a 5% stake in that indigenous LNG project that hopefully gets built with an option to go to 10%. And all of a sudden, you kind of fast forward the clock and Total Energy, does Carney push forward on that LNG project? We think he probably does. And you'll be asking the question, well, where's Total Energy going to get all the gas from? Right? Saudi Arabia came out. Saudi Arabia here 2 months ago, and they bought 20% of Petronas' Northeast BC assets, paid triple the price of where the publics are trading, and have a 5% stake in LNG Canada. Right? Large pensions of Canada. I'll never buy hydrocarbons again. Quietly, they buy assets off of Sempra in the U.S. LNG Gulf Coast 2 months ago. It's happening right in front of our faces. I'm trying to describe to everyone, this is why the multiples are expanding. What expands multiples is when you feel some version of, I think we're going to need this stuff for a while. I think we're going to need more of it. And I feel like we're going to, the IEA is another good example where all of a sudden it's 2050 and everyone goes, see, I told you so. This is extending asset duration within the asset class. This is expanding the multiples. We're in the digestive phase, but everything I'm describing has actually been happening in front of our faces, but people have been too focused on government policy.
Yeah, that's a great perspective. And, to be honest, even Mark Carney said that everybody's trying to boil this down to one pipeline. And it sounds like for even you as an energy investor, you're not getting fussed about like a pipeline approval.
Yeah, no, I think it's what I said. Price drives sentiment, right? I'm a guy that buys equities. I say to my sales team all the time, price drives sentiment. The higher they go, the more they like them. We have had other sectors outperforming our sector. So capital has been getting FOMO, chasing other stuff, but we haven't had our commodity cycle yet, right? What ends a commodity cycle is a capital spending cycle, but what ends any cyclical cycle is a capital spending cycle where investors embrace the spend. Well, we're seeing that in other areas of the market, right? This is giving me alarm bells going off of oil sands 2013 as we watch this. But as it relates to energy,
like all these AI companies that are like, okay, yeah, I'm going to pour a couple $100 billion here, and instead of flinching, the market's like, love it.
Yeah, and to be clear, the whole call is how long does that go on for? Like the capital spending cycle started in energy from 2007, it went on to 2014.
Can go on for a while.
And so it just went a lot further than you ever thought. But when you actually go and look, like we were looking this morning, you're watching the free cash flow of a lot of these big AI businesses, which are great businesses. The free cash flow profiles that they were all capital light businesses, free cash is down 40% year over year. All of a sudden, we're getting a flag this morning on tech credit is quietly moving higher. Well, oil's at 60 and energy credit's tight. So like these are the subtleties that are happening beneath the surface. And you always want to pay attention to not the stuff on the front page news, but the stuff that could be the front page news. I think energy is one of these places that just isn't getting any love, right?
Your point on credit is interesting. Basically, what you're saying in layman's term is like people are charging a little bit more to own credit in tech, which might be a hint of nervousness, versus they're charging a little bit less. It's getting better to own the debt of energy companies, indicating maybe less nervousness. So that's interesting, something to pay attention to. I want to pick up on something you said about ESG, because even as people like yourself and, you know, you're one other peer in the space in this country, we're talking about these are fabulous companies. They're gushing cash. They're buying back, you know, just nobody wanted to touch it. And I think there was that additional kind of black mark because pension funds had said, you know, for ESG reasons, we don't buy oil companies. Where are we in that sentiment? Is ESG dead?
So let's play it out like this. 2020 lows, Norges Bank, CNBC, or Norges Bank will never buy hydrocarbons again. 2021, energy starts outperforming other sectors, and they're on CNBC. They go, no. Like, we said that we will buy certain hydrocarbons again. 2022, they're on CNBC going, no, we're overweight hydrocarbons. We love hydrocarbons. Hydrocarbons are awesome. So that's a good example of it's all fine and dandy until you're underperforming and hurting investors' capital. And that playbook was happening on that whole inflation run on the 2022. And so as you fast forward to like, where are we today? I think these companies are running really good businesses. I think they're way more present on governance and this type of stuff. But I think this is all page 27 of the presentation now, right? I mean, these companies have been running really good businesses, paying attention to, can we use more natural gas within a lot of these power streams, or fracking or drilling wells or whatever it is instead of diesel? They're doing this because they can make an economic return on it and do a cheaper drill, if you will, or frack, if you will, for their clients. It has to make economic sense. And that's kind of come back into the forefront of, we will do this if we can make a return for our investors on it. But I'd say it's just taken a backseat from where it was. But I think all of that is actually really, really good. But again, it's because of the IEA and all these things that are slowly changing in front of our faces that I think this other stuff has just kind of gone to the rearview mirror.
Okay, we have got to talk about M&A, which has also been a huge catalyst. The foreign players, as you mentioned, again, maybe not 1A type of stories, but that supported valuations. And of course, this summer, Strathcona essentially, and Adam Waterous putting MEG in play. And after a lot of drama, eventually it was Cenovus that got it. I don't know if you have any comments on how that situation played out, or just how you're watching M&A unfold as an investor.
Yeah, you bring up a really good point. And I think it's important because, I mean, we can all get excited about what's been happening in energy the last month or month and a half, but that has not been what's happening kind of throughout the year. To your point, like, there's been a lot of complacency in the public markets on energy. Other sectors are outperforming. I'm marketing to investors. Most are looking down, not up. Yeah, but. That's all I've heard throughout 2025. And so there hasn't been embracement within the public markets. And again, energy is all the way down to 3% energy of the S&P 500. This is the opportunity as we've been trying to educate this to people. But what hasn't been here that is now very much present are all these other pools of capital that weren't here 2-3 years ago. The companies are cashed up, to your point. There's hostile bids showing up. Like, I remember Bruce Chernoff, our founder, talking about in the early 2000s, it started with Mike Rose's Berkeley company got a hostile bid. He didn't want to sell. He got a hostile bid, and then 2 months later, he wasn't around. And then all of a sudden, more of these hostile bids started happening, right? I bring that up on the you say the Strathcona side, like Parex just did the same thing to Geopark, a little bit smaller. And so it's when this becomes a trend, but all of a sudden Cenovus comes in with a cash bid. Hey, we're not going to up this cash bid. They upped it another 2 times.
Yeah.
Then all of a sudden you're hearing more on the pension guys care about energy again, right? You're watching the Keyera deals and massive lead orders on the Keyera with pension funds, right? All of a sudden US private equity is very much back in our backyard in Canada. All these US PE guys are here in a massive way. And they're providing a bit of a bid. You watch this Quinnock deal happen, And Carlyle Group is all of a sudden the backer of Quinton, right? And then you kind of, this carries through to, my buddy held a conference with National Bank out in London. And all of a sudden he's saying how the London guys are buying Canadian energy. Long-term holders, the London guys care about our sector again. So these are the things that slowly happen over time. But what's very obvious to me is it feels like behind the scene in the private market, it's a bull market. There's competition for bids. If we don't up our bids, someone else is going to get it. This is all happening because the scarcity of resource in our backyard. There's been so much M&A the last 2-3 years. There's not as many megs behind. There just isn't. And so you got to get the next one or there just isn't going to be anything left. This hasn't been screaming at you in the public markets because of the complacency, but those two things don't match up and they're going to at some point.
And that's fascinating that that's happened even as like you spend like 2 seconds on Twitter, which is probably too much time. And you feel like it's a different vibe, like regulation, it's just a total a blight on the Canadian energy sector. And then to hear you say like, no, actually it's starting. There's a ton of international interest regardless of what happens from a regulatory perspective.
Yeah, you can feel, even there's just pools of capital up here through Stampede that you could feel these US guys are back here in a big way, but I feel like that's carried through to other pools of capital. You're hearing like, okay, yeah, New Vista sold and this and that, but the US producers all of a sudden care about energy again. Ovintiv's back in our backyard. I thought Ovintiv was just going down to the US because that's where they should be. It's quietly all happening, right, Amber? And I think that's notable for investors because it all subtly changes over time, and then we all wake up and we all like Canadian energy again. That's how it always plays out. But the subtleties have already been happening.
All right, well, let's find out where to be and dip into the mailbag. The mailbag is brought to you by BMO ETFs. If you're a do-it-yourself investor looking to take control of your portfolio, BMO ETFs makes it easy. Whether you're exploring stock replacement strategies or you want to find ETFs that hold your favorite companies, their tools are built to help you invest smarter. Check out the ETF Compare tool, the stock replacement tool, and news and insights under the tools section at bmoetfs.com. It's perfect for analyzing your options, spotting trends, and building a portfolio that fits your goals and timeline. Okay, David, our first question in the mailbag is Whitecap. Should I hold on to Whitecap with their 6.7% dividend yield, or should I look elsewhere? This one coming from James Gordon McLean on Instagram. What do you think? It's a nice dividend yield, and it's been raising it since 2021 after, of course, they had to cut it, but it's been steadily increasing that dividend.
Yeah, look, Grant Fagerheim's a rock star, and I would just say something for people to focus on is if you play out the last 2-3 years, the focus by investors has been shareholder returns. Where's my dividend? Where's my buyback? Where's my share? That's all the focus. What have some of the really smart guys been doing? Grant Fagerheim, Mike Rose from Tourmaline, Murray Edwards, CNRL. They've been accumulating resource. They've been buying resource because they recognize, look, we're not at the COVID lows, but it's still a very good entry point in terms of the grand scheme of the cycle. And so they've been buying resource. And all of a sudden now, as those pools of capital that I described are here, you can feel this scarcity factor. And you kind of look back and be like, I wonder if I should have paid up for that resource. So I think Grant's had a really good view of the cycle. We haven't been massively overweight oil in our portfolio. There's a lot of bears in the room, but just because people are bearish doesn't mean we got to be all bullish. We've been very focused on the Clearwater and some other areas, but Whitecap's a holding in our income fund. We think Grant's doing a great job.
And you like the deal? They bought Varen in March. I think it closed in March. And actually the stock's up since that deal.
Yeah, I would just say like Grant's setting himself up for if you eventually get commodities up, other sectors quit working, and there's a flow of capital back into energy. He's at a market cap size that you can see how there's going to just be more eyes on a Whitecap than there would have been, right? And so some of these deals, you got to finance with equity. Some of these deals, like the XTO, he did it all with cash. And so you're kind of beholden to the other parties sometimes in terms of how you do that. But he's built up a pretty darn good resource and asset within Whitecap.
Let's talk about Abaxx Technologies. This one's been on the scene for a couple of years, but just exploded higher recently. The question is, it's a currently held position from our questioner, and it's in a couple of Canoe funds. What do you think about the current contract adoption in LNG, alongside what you're looking for in 2026 from the company at the exchange level? We should probably start describing what is Abaxx. I think of it as kind of like a commodity trading platform, and there's a bunch of tools. There's exchanges. There's also, deep tech involved. There's kind of a crypto angle with stable coins. So there's a lot there. Tech that touches commodities. Did I summarize it well enough?
You did pretty good, I think. Yeah, so this is a really good example. When you buy the Canoe energy funds, we aren't just an oil fund, right? A lot of times people go to me and they're just like, I like energy too. And then they're sitting there and they own CNQ, Suncor, and Cenovus. Well, no, you like oil too. If that's your energy holdings, you're playing oil. So look, we like the setup for traditional hydrocarbons given where we are in the cycle, we believe. But we look at everything. We look at everything across the board from uranium to stuff like Abaxx Technologies. And Abaxx Technologies, these are rockstar guys. Jeff Curry's on the board, Josh Crum, ex-Goldman, the right pedigrees there. It's like me coming to Canoe. You just look at these guys. A lot of these guys, Joe Rea built out ICE in his prior days. They're building out, and they actually launched a commodities clearinghouse exchange that trades the physical markets. And when you think about the LNG market today, how does it look? You got JKM in Asia, TTF in Europe, and Henry Hub in the US. There's 3 major hubs, as every country globally is building out LNG post-Russia invading Ukraine. Is it all not going to naturally happen where we wake up and there's just more places to trade natural gas in the coming years? I think that's a very high probability. So this is something I'm really proud of in our funds. We gave these guys capital 2 years ago at $5.75 a share. And today the stock's over 30, right? These are things that have been happening in that digestive phase for hydrocarbons that I'm super proud of, to be like, we're the largest institutional shareholder, right? And I feel like it's been a rockstar call with really smart people.
It's now a $1 billion market cap company. Great call by you and the team. Up 260% so far this year. Like, how big can a company like that get? You mentioned ICE, the exchanges. Are we talking about it eventually being, kind of a large cap? And do you hold for that long when you're sitting on such explosive gains? These are startup gains.
Yeah. Look, in the grand scheme of things, if you said like lay out expectations, they're on an S curve. They're early. It takes a long time to get through this S curve. But then if you eventually get traction, like these exchanges are super profitable businesses, right? Like you and I should own them forever. And so when you look at Abaxx, or Abaxx rather, and you look at what they're doing, we actually look at the technology side that maybe we didn't have that in the cards as much. And through their whole ID++ system, they're actually disrupting the other exchange markets. Like if this actually has traction and you can clear on exchanges and all Visa and MasterCraft like that, and you already know that the trade's been verified, this has massive implications to not just LNG and commodity exchanges, but other markets. And so when you look at some of the other market caps of some of these peers that have kind of sort of stuff that rhymes with Abaxx, I mean, their market caps are $5 to $15 billion. And so we're excited about stuff like this. Like these guys are super smart. It's going to take a long time to build out. We got to give these guys some time, but they're on the right track of all this.
So you haven't trimmed, even though...
Look, we've trimmed a little bit just with some of our weightings.
Mm-hmm.
We've launched a new fund here a few months ago. We've actually crossed some into that new fund too. And so we've moved some chips around here and there, but we still think that there's really good upside with the stock.
We've got another question. This is a pipeline question. Why is Southbow's dividend so much higher than other pipeline companies? This one coming from Andrew on X. Dividend yield of 7.3% compared to TC Energy, which has got a 4% yield, and Enbridge, which is at around 5%. Do you like Southbow?
I would just say we have had more royalty exposure than we've had infrastructure exposure. It's just been a bit of a call in terms of these stocks have actually all done quite well. When you look at Southbow's, you pointed out the dividend yield, but the multiple is actually not that far off some of their peers. They trade around 10 and a half times or some version of that. It's not that far from Pembina, even the traps of the world at 12. Like, they're all kind of relatively close. We'll see what happens here over the next bit on the Southbows of the world. You can kind of feel this government policy that we talked about. Are we going to build more pipelines to the West Coast, but are we going to actually have stuff like Keystone XL again? Like, these could be expansions that we never saw coming, that a Southbow would be in the middle of that. And so then it will go to, how are they going to fund that? But the market likes growth, right? Growth expands multiples, right? If you just have a blowdown business with no growth, why are we expanding the multiple? And so that team is pretty smart over there, and we think that it'll do pretty well over time. But we don't own it in our funds right now. We own other stuff.
ARC Resources, we've got a question from Fatima on Instagram. Can you ask why ARC has been falling when gas is up?
Yeah, I mean, there's
been
a focus on...
Do you ask yourself that too?
Pardon?
Do you ask yourself that too?
Well, there's been a focus on ARC on their Attachie play. Investors, that was the growth wedge for the company. They've walked back some expectations there. They really want to understand what they actually have there before they're pushing forward on that type of stuff. But when you start walking back, okay, we're not going to be 35 to 40,000 Attachie phase 1. We're going to be 30 to 35. We're not going to start spending on phase 2 yet. We're going to push this decision out. When you kind of have these things, people start getting nervous, right? And I would just say the positioning on ARC that we pay attention to, a lot of people really liked ARC over the last 12 months, right? We could see this in massive overweights across the board. Our energy funds actually trimmed ARC and took the weighting down to 0 on the back of, we just have a lot of ties, and we were hearing things on Attachie that we were just like, I just not sure if it's going to be the same homogeneous reservoir that all these other ones are. And so now that the market's all freaked out on that and taking the stock way down, we're more like, okay, they're setting the bar lower, and I think this is going to set up over time. But that's kind of the reason why the stocks got beat up relative to natural gas prices.
All right. So you kind of like had a sense about Attachie, and now maybe it's beaten up enough that it could be a buying opportunity.
Yeah, I mean, this is why you pay your manager to have that boots on the ground, that has all of his buddies as engineers and stuff. And we're really proud that we're kind of able to avoid some of that stuff. And sometimes we move out of stuff and the stock keeps going. And ARC did that, to be honest. Like, we sold some and then ARC kept going up. And so, but now, like we're not running into ARC. We don't own ARC today in our funds, but clearly the market has put some sort of discounted valuation or expectation on Attachie.
The market's putting an expectation on Athabasca, and you touched on this at the beginning. Everybody's looking for the next M&A candidate. Croft Mac on Instagram wants to know, is it in play? Is it a target? Is it an acquirer? How do you think about Athabasca? Is its run-up warranted?
So I always the best advice that I got against Steve Lark, ex-head of sales from Peters & Co., he always said a really good thing. It's just like, are you building something that someone else is going to want to own one day? And that's kind of just stuck with me nonstop. And when you look at the Athabasca assets, they're really good, right? They're really good. This management team has completely turned this company around from how it looked 5-10 years ago. And they have long life reserves. They're building out their Leismer asset. They're building out their Corner asset now. They're sitting on cash. They're buying back shares. Like, they're just doing all the right check marks that investors would want them to do. So now you're just debating, well, what's the right value for the stock? And am I paying too much ahead of that too soon? And that's where you go through these cycles and the stocks go up out of the gate. I'll give one example here. I remember Mitch Malloy from Peters & Co. He was just like, we did this deal with this group and they took a big position in Canyon, a pressure pumper back in the day. And then they sold half their position at 3 because it went up from 1, and then they sold the rest at 6. And then it went to 20, right? Because you just weren't respecting where you were in the cycle. And it's just, as the capital comes in and the valuations go where they go, I feel like that's a version of Athabasca right now. Meg sold for 7.5, 8 times strip cash flow, but all of a sudden you wake up 2 years from now, the commodity's higher, the multiples are even higher, and Athabasca's $12. And so, but if you checked oil back to $50 in the next kind of 2-3 months here after a big move and spook people a little bit, you could get a check back in it. But there's no question, these guys have great assets. We think the big theme that people should be paying attention to is because of the scarcity of quality resource, I think these guys that are left with the quality resource 2-3 years from now are going to trade at way higher valuations than people understand today.
We, talk about questions that people have. We got a question in the mailbag about Imperial. This is from Anthony on Instagram. Why has Imperial dramatically outperformed other oil and gas companies? I mean, it's up 60% so far this year, 6-0. Again, as oil prices are down 16%. CNQ is only up 10%. Suncor, which has done well, is only up 26%. These are total return numbers. What do you make of that?
Yeah, I remember back again. So a lot of analysts and stuff go, well, let's not talk about Imperial yet, but you'll just go like, this stock's expensive because it trades at 6.5 times and the peer groups trades at 4.5 times. Well, when you go back to that 2012 to 2014 period, it's just like you saw companies trading at 13 times versus others at 4 times, right? Big divergence of the valuations and multiples. Imperial was one of those stocks. Back in the day, Imperial traded at 15, 16 times cash flow. And so today, the multiple and valuation's been going up, but the big tailwind on the year has been refining, right? The refining subsector has done really, really well. Go look at all these U.S. refiners, the Valeros, Marathons, Phillips 66, the Suncors, the Imperials, like the integrateds have quietly been a really good subsector of energy. And so I would just tie it to a little bit of they've had their buyback, they've been buying back their own shares, but beneath the surface, the subsector's done really well.
Do you still like integrateds? Do you think like where we are in the cycle, is integrated still like the next good place to be?
So I would word it like this, and I kind of touched on it, but I didn't really kind of keep going on it. At the start of cycles, you just go buy Suncor and CNQ and Exxon and Chevron and Schlumberger, and like you just go up cap. That's where you should go risk adjusted. Like we can all brag about what we bought in the COVID lows and this and that, but like we should have all just gone and bought CNQ. Risk adjusted, that was the right call. But as you mature through, you want to start developing some mid-cap exposure. You want to start trickling some chips down. If the next move is what I think it's going to be, we're going from that doubt phase to optimism, and we inflect higher at a time that everyone's underweight the sector still and other sectors quit working, you'll feel like you want max risk. And that's where you'll feel, and again, it's fundamentally happening on the scarcity of resource that I talked about too, on these mid caps that are left that have that scarcity resource tied to that bigger macro cycle. We in our funds have built up more mid cap exposure. I'd say the last 1-2 years, it's been a version of every question's been, are you a natural gas guy or an oil guy? What camp are you in? You got to pick one, Szybunka. And I'd say that's what everyone's still talking about. But what are we telling our clients? You should have less large caps and a bit more mid caps. It doesn't mean you just leave the party on the large caps, but I think you're going to really start to get rewarded for some of these mid caps. And that's why our funds have been outperforming the last 3-4 months, right? It's this mid cap exposure that's really carried the baton for us.
I mean, think of a name like Baytex. We actually got a question about that, which kind of left for dead. And then it does a deal. It sells its Eagle Ford assets for a pretty penny, over $3 billion. And the stock kind of picks up again.
Yeah. So that's where you got to be a little bit careful. You're in the digestive phase. You check back oil. They're not expanding the multiples for all of the companies. I always say to our investors, you don't want to be down 35% coming out of the digestive phase or thaw phase. Well, if you own Baytex, you are, right? And so, but then these guys aren't idiots. They understand some of the parts of my business and where the chips should be and how we should realign stuff. And so they're just realigning their portfolio. And they sell the Eagle Ford assets, and you can say, well, they paid X, and now they're selling them for X, and it's lower than what they.
Yeah.
In the grand scheme, they're trying to position themselves for the best company moving forward. And so today they have $1 billion of cash, or round numbers around there. They can do share buybacks, they can do SIBs, they can go buy more assets. Like these are the all of a sudden chips that they have at a time that the market was valuing them way in the hole. And so there's a re-rating that's been happening the last little bit. Does it keep going? We'll see. But it's names like that if all of a sudden you come out of these periods and then you go on a commodity move in oil 70, this is where you get the commodity and the multiple expansion at the same time.
We
And
get so many questions about it. I feel like because it was such a heartbreaker stock.
yeah.
And I wonder,
And
like, when there's that kind of heartbreak, do people even come back to it when the story starts to improve? There's been a lot of upgrades after it did that deal.
Yeah. Yeah. And so I think it just depends of where we are within this cycle on whether like for us in our funds, like we actually owned some Baytex leading into that news. But the weighting that we've had on that is much lower than some of our core weights, right? And post these big moves that you have in the last 30, 45 days, you take some chips off on some of these things that have done really well and you move chips around to kind of some more of your core holdings. And so, yeah, we wish those guys well in terms of realigning this company.
All right, well, let's get into your high conviction ideas in the energy sector. ProPicks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, the first stock is Canadian or CES Energy Solutions. This is like a service company. Why do you like it?
Yeah, so a theme in our portfolios is if the commodities just stay right here, which businesses are mispriced, okay? And CES fits that bill. And when you look at where did a capital light service company like CES, their production chemicals, alongside drilling fluids and stuff like that. Companies like CES used to trade at 13 times EBITDA and stuff like that through the last run, right? Because it was such a good business. And so when you look at where CES was a year or two ago, it was at 4.5, 5 times. Today, the business is 5.5, 6 times. But it's important to pay attention to the subtleties too, right? Like you mentioned, it's a service company, but they're grabbing more US market share. They have a tailwind of industry across their back of longer laterals being drilled, more frac-intensive wells being drilled. The US rig count's down oil rig count's down over 10% year over year. CES just put out their Q3 numbers and they just put an inline print on EBITDA from where they were last year to this year, despite the headwinds of the drilling count going way much lower, right? And so these guys have done a really good job. They're a capital light service business. Today it trades at 5.5, 6 times EBITDA. Like these guys are going to keep grabbing revenue market share. They just won a big contract award. The stock was up 15% for us on Friday. It's a top 5 holding across our funds. If you start putting 8 times multiple on the 2027 forecast, it's a $17 stock. And so these are things that if oil and commodities just stay right here, I think it's going to go to that 8 times multiple. And what happens if the commodities go higher, right? It's going to have even more upside. So we don't need higher oil prices to make money in CES in our view. We think that can naturally just happen for where you're valuing the business today.
The market share story is interesting because like 5 years ago, it was like 13% US share of the drilling, and now it's like a quarter of it. Yeah. How high does that go, do you think?
Well, if you recall, like Champion X just went away, right? And so Champion X just got bought out. Like we think these guys are going to grab more market share from guys like that. When you look at this contract award, they kind of hinted to everyone that like we won this offshore contract award. But then when you delve into the details, you can't really work for some of these big super majors unless you're the full gamut stop guy. So all of a sudden you get the offshore work and maybe you get a little more Permian work at the same time. This is all tailwinds, right? This is all going in the right direction. So we'd expect that market share number goes higher over time.
Your next 2 picks have, and by the way, normally we do 3, but you really bonused us out. We're going to get a bunch of picks here. They have a theme and they're Clearwater oil companies. And you mentioned that you like this play. It's a heavy oil, a play in kind of west central Alberta, like 300 kilometers north of Edmonton. So there's 2 companies that you're talking about that are kind of these Clearwater plays. That's Tamarack and Headwater. Talk to me first about the play. You know, what's exciting about Clearwater, and then the exposure you're getting with Tamarack and Headwater.
Yeah, so this is the best oil play I've ever seen in my career. And that's where, when you're just looking at this play and how it's kind of matured through time, they're drilling multi-leg wells. They're not fracking the wells. They're just drilling multi-leg wells. This is not service intensive. It's easier to drill. The spud to on-stream times happen really quick. But the big intriguing part of the play was just the declines don't happen like shale where it goes down really, really quick. So you drill your well, you get your money back from the cost of drilling that well in 7-8 months. And then you get that money back again 3 or 5, 6, 7, 8 months later. And then you get it back again. And then you get it back. You get multiple payouts on the well. Versus when you drill a shale well, you might get that money back pretty quick in 12 months. And then you never get second payout in some of these plays. And so the play was very intriguing. But then what's also transpired in the last 12 months is they started injecting a bunch of water back into the formation. And what that is going to do is take the oil recovery factors from 5 or 7% to 20 to 30%. So now not only are you getting those initial payouts, you're getting even more payouts because you're bringing the decline rates down. You're lowering the sustaining capital. When you lower the sustaining capital, you got more money for dividends and buybacks and more water floods and more wells. Like, this is all massive tailwinds for anyone with exposure in this play.
So let's talk about the difference between Tamarack and Headwater, because, when I talk to people about these stocks, these seem like companies with vastly different health. People love Tamarack and they're maybe a little bit concerned about maybe payouts at Headwater, debt, whether they have room for buybacks. Is there a major difference in the financial health of these companies? And do you see consolidation?
Yeah, I mean, that's a good question. And to kind of just set it straight, there's been no capital in our space the last 2-3 years. So it's all these hedge funds. Are you in the Tamarack camp or the Headwater camp? Like, which camp are you in? It's like, I am both.
Yeah.
I am both. They're all exposed to the right plays. So, and that's quietly been what's happening. Tamarack's leading on the year, then Headwater plays catch up the last month or so. We like both of these companies. Tamarack did a rockstar deal. Steve Bytel's on buying Delta Stream. This is a really good quality asset. It set this company up with inventory for the next 10, 15, 20 years. Headwater's been more finding plays, but then when you look at what these guys have found, they just found their Pelican play. And the Pelican play, like, they drilled a well there. It's been doing 500 barrels a day. It came on. You're like, oh my God, this payout's going to be 3-4 months. 8 months later, it's still doing 500 barrels a day. Like, they have a prize there. They're going to do polymer flood. They're going to inject polymer into this reservoir. And you're going to get so much cash and free cash out of this play over the next how many years. And so when we look at both of these together, we think you should own them both. We think that both of these companies have various attributes of just getting multiple payouts over time. And to your point, I don't know how the consolidation is going to ultimately play out. But when I look at where you're valuing these Clearwater businesses relative to their peers, I think they should be valued way higher. Quit focusing on the multiple. Start focusing on how much free cash are these businesses going to spin off in the next 5 years. Headwater's 60% of their enterprise value that you'll generate in free cash in the next 5 years. Tamarack's 50%. The peer group's closer to 25%. Wow. So anyone who buys these companies is a better company the next day, right? Headwater, it's just like you mentioned, like, are they in a good position or not? They're sitting on cash. They have a wicked play. Like, this all slowly takes care of itself over time. And if you don't re-rate the businesses, they won't be around. Well, we'll see how this all plays out. I'm not going to know exactly how it will, but any companies that buy these companies are going to be set up really, really well.
Okay, that's juicy. Your third pick, royalties, Prairie Sky and Topaz. And I think let's talk about why royalties in this part of the cycle, but I'd also love to understand, like, if you are structuring an energy portfolio, how do you think about royalties versus producers and kind of the weighting that you want to have? And I guess the role that it plays in your portfolio.
Awesome question. Like, really good question and really mature question on portfolio setup. And like I described, I think on this, we're getting to the point in the cycle where you want more mid-cap exposure. And so we have some of that. We have CES, we have Headwater, we have Tamarack. But let's not just run into all these mid-caps and all of a sudden there's a bigger check back and you lack liquidity or what that looks like. when you look at these royalty companies of Topaz and Prairie Sky, their free cash flow yields are the same as the producers. This makes absolutely no sense. These companies are really good businesses. Again, just like exchanges, royalties are compounding businesses that if you just own these businesses over a decade, they just compound for you, whether that's dividends or share buybacks or just taking that free cash to go buy more of a play or whatever that is. And so we don't think the royalties are priced right. We think, again, if the commodities just stay here, they can go up significantly, but they do play a really good barbell, if you will, within a portfolio. We've been taking the weightings of those things up as our Baytexes are up 30% in the last 30 days. Are you sure you don't trim a little of that to buy some royalties that haven't moved? And they provide stability. It's not just about the upside in our funds. It's about protecting the downside and managing that. You know what? We've had a good move here. Let's move more chips over here. But the royalty weights have been going up in our funds because at the end of the day, the businesses are mispriced. To use a little comparison, Franco-Nevada, Wheaton Precious Metals. Well, these are royalty businesses in the metals gold space. Great companies, wicked companies. But they trade at 25 times plus $3,500, $4,000 an ounce. You're trading these oil companies at 13 to 15, 16 times cash flow, $60 oil. That's where you look at these businesses and go, I think when Prairie Sky, as you recall, Prairie Sky IPO'd in 2014, it was hot. It was the end of the cycle. They brought it out at 25 times. It went to 30 times cash flow because it was such a good business. But today at 16 times, it's expensive? No. It's going at 20 some, right? And so that's where these things are really good bellwether core holdings for us in our funds. And we think over the cycle, they're going to do really, really well.
Let's end it with Tourmaline. I like to joke, whether it's CNQ or Tourmaline, you don't get fired for picking one of those two stocks. And we had a great interview with Mike Rose because the company's at a bit of a significant point, right? You mentioned a lot of companies are not doing capital spending. Tourmaline is. It means that you might see less in the way of special dividends as they look to build up their base dividend. And so investors, I guess they have questions about that and the natural gas outlook. So with that context, why Tourmaline?
Let's start 50,000 feet. The natural gas market is growing at 2x the rate of electricity, and it's growing at 3x GDP. 50,000 foot view. We're going to need more gas, right? And so you can feel that, you can see that, but when I go to all the conferences still, everyone's like, we're going to need more gas, but they don't want any of the companies to grow. And those two things don't match, right? And so as again, we take ourselves back to 2014, what was happening? No dividends, no buybacks, no shareholder returns, grow, spend, rah, guns are out. Well, what have we been in? It's been like, give me all the money back, don't grow, shareholder returns, that's all I want, hand me back all the money. That was wrong. This is wrong. They're both wrong. And that doesn't mean that you go to those extremes, but there could be a balance within there. And you just got to remember, these LNG facilities aren't just 10-year facilities. Like there are 50+ year facilities, all these LNG, US Gulf Coast, Canada. You're going to need gas for a long time. And when you look at that, and you see the Total Energies coming back quietly, the Saudi Arabia is coming back, like this is all happening. And what has Tourmaline done the last 2-3 years? Mowed down resource in Northeast BC. Mowed it down. Bought Saguaro, bought Todd, bought Strathcona's piece, bought the other part of Saguaro. You look at a land map now and you're just like, well, they dominate Northeast BC. Mike Rose is smart, you guys. Like you can treat him like he's dumb, but he's the smartest guy in the city. And so when you look at what he's built for where the puck's going, and specifically on gas, and then the data center stuff all coming in behind, like he has built up resource and he has 75 years of resource. And everyone still goes, what's his free cash flow yield? Right? And I'm telling you, you're going to come in the next 12, 18, 24 months, whatever it is. And some of these big boys are going to need a lot of gas. And he will supply to them at the right price for shareholders. And so however that plays out, we don't really know. But the brain from investors will flip as soon as that happens to, well, these guys with lots of resource should be valued higher. And that's where the puck's going. That's how it will play out over time. And he's just caught up in doing something the market doesn't want necessarily on the growth side, but it's actually bolstering the free cash flow profile within Tourmaline. And so we think for the long-term shareholders, we think the pension fund should be all over stuff like this. Like park capital, get long, ride this out on a multi-year thematic, and wake up rich. That's the playbook. And we think he's doing a good job.
Wake up rich. I think I want to steal that as a tagline for the podcast. David, it's been an absolute pleasure. And I feel like we're clocking in and over an hour. And I should just let our viewers and our listeners know you've done that all standing. And you still have a full job to do. So I appreciate you standing up for us for this last hour. So insightful. Thanks so much for joining me.
Really appreciate you having me. Thanks a lot, Amber.
That's David Szybunka joining us from Canoe Financial. Make sure you tune in to our next episode. We're talking small caps. Jordan Zinberg's coming back on the podcast and Bedford Capital. And yes, some of these small caps and some of his favorite names have been run over. He's going to address that and tell you what he's doing in the fund. If you have any questions, email us questions@inthemoneypod.com, and we'll see you on the next episode.